In this example, we are going to calculate depreciation expense for every year using the double declining balance method. You'll see on the screen an example. We have a truck that was purchased at the beginning of the year for $20,000. The company estimates that the truck will have a residual value of $2,000 and have an estimated useful life of 5 years. So the first thing that we need to do is to calculate our double declining balance rate. And we do that by taking 1 divided by the useful life in years and multiplying that by 2. That doubles the rate, hence the name, the double declining balance. So, for us, our rate, we have 1 divided by the useful life, which is 5 years, and we're going to multiply that by 2. Get us our double declining balance rate of 0.4 or 40%, meaning that every year over this asset's useful life, we will depreciate it by 40%. The double declining balance method is an accelerated method, which means that we recognize the most depreciation expense in the first year and the least amount of depreciation expense in the final year of the asset's useful life. The theory is that we receive the most benefit from the asset in its first year and therefore should recognize the most expense. When doing the double declining balance method, the best way to start is to establish a chart. So we'll have the year that we're going to depreciate. We will have the beginning book value of the asset that we will be dealing with. We're going to multiply that by our double declining balance rate to get to our depreciation expense for that period. We will then want to calculate our accumulated depreciation as of the end of the year and our ending book value for that asset. So this is the chart that we'll be using, and again, this is the easiest layout to figure out our double declining balance method. So, in year 1, my beginning book value. Remember, book value is calculated by taking the beginning initial cost of the asset and subtracting away any accumulated depreciation. So when we're looking for beginning book value, we're looking for the initial cost minus the balance in the accumulated depreciation at the start of that year. Well, we bought the truck on this January 1st, and on January 1st, there was no accumulated depreciation. So that means our beginning book value in year 1 is just the initial cost of the asset. We're going to multiply it by our depreciation rate of 0.4. So we take our $20,000 initial cost and multiply it by our depreciation rate of 40% in order to arrive at our depreciation expense for the first year. In this case, $8,000. Remember, our journal entry to record depreciation is a debit depreciation expense and a credit to accumulated depreciation. Since this is our first year depreciating the asset, that means there'd only be $8,000 in accumulated depreciation. At the end of the year, we need to calculate the book value again. Remember, our book value is the initial cost of the asset minus accumulated depreciation. So, our initial cost of the asset was $20,000, and we're going to subtract away from it our accumulated depreciation, which is now $8,000. So our ending book value is $12,000. Ending book value from one year becomes beginning book value for the next. So at the start of year 2, our beginning book value is $12,000. We carry down that percentage rate of 0.4% or 40% that we have. We do our simple math. We take our beginning book value and multiply it by our never changing rate of 40% in order to calculate our depreciation expense for year 2. So in year 2, we would record $4,800 in depreciation expense. Accumulated depreciation is a contra asset account and is on our balance sheet, therefore making it a permanent account, which means their balance does not get closed. So we would add the $4,800 in depreciation expense for year 2 to the $8,000 in accumulated depreciation from the prior year to arrive at our new accumulated depreciation amount of $12,800. We now need to again calculate our ending book value. We take our initial cost, again, which is the $20,000, and we're going to subtract away our new balance and accumulated depreciation of $12,800. That gives us an ending book value of $7,200 at the end of year 2. For year 3, ending book value from one year becomes beginning book value for the next. So we start year 3 with a book value of $7,200. We use the same double declining balance rate of 40%. We multiply our beginning book value by our rate to get to our depreciation expense for year 3. So for year 3, we would record depreciation expense of $2,880. We would add that $2,880 to our previous year balance of accumulated depreciation of $12,800 to arrive at this year's depreciation of $15,680. Ending book value. We take our initial cost of $20,000 and we subtract away our new accumulated depreciation value of $15,680 to arrive at our ending book value of $4,320. For the start of year 4, our beginning book value is our ending book value from year 3, which is $4,320. Again, we bring down that 40% double declining balance rate, and we calculate our depreciation expense by multiplying the two together. So, in year 4, we would record depreciation expense of $1,728. We would add that $1,728 to our previous accumulated depreciation value of $15,680 to arrive at our new accumulated depreciation amount of $17,408. Ending book value, we take our beginning cost of $20,000 and we subtract away our accumulated depreciation of $17,408. That gives us an ending book value of $2,592. Notice that so far we have not done anything with the $2,000 residual value. Straight line method and units of output, we subtract away our residual value at the start. With the double declining balance method, we do not factor out the residual value until the last year of the asset's useful life. So in this case, the last year is year 5. For year 5, we take our ending book value from last year, which is the $2,592, and we subtract away the residual value of $2,000. We do not multiply it by our double declining balance rate of 40%. We merely subtract the two, the beginning book value minus our residual value, get to how much depreciation expense we recognize in the final year of the asset's useful life. We add that $592 to the previous accumulated depreciation balance to arrive at our ending accumulated depreciation of $18,000. We will again calculate our ending book value by taking our initial cost of $20,000 and subtracting away the $18,000 in accumulated depreciation, which gives us an ending book value of $2,000. Notice that my ending book value matches my residual value. No matter which method we use, straight line, units of output, or double declining balance, our ending book value should equal our residual value at the last year of the asset's useful life. Our book value can never drop below our residual value. So keep that in mind, because if you mistakenly had multiplied the $2,592 beginning value by the 40% double declining balance rate in year 5, your ending book value would have been lower than $2,000. And again, your ending book value in the last year cannot be below your residual value.